Hello everyone, welcome to another edition of Emkay Macro and Market Movers. Today we have with us the Chief Economist at Emkay Global, Ms. Madhavi Arora, once again. Thank you so much, Madhavi, for giving us your time. And what I'd like to start off the discussion today with is that obviously we are now in 2025, a new year, and what about 20 odd days, nearly almost the month is over, but there's already been a lot of volatility across global markets and India as well. So how do you see the year 2025 for the Indian economy, and what are some of the key issues that India has to deal with in this calendar year?
Thank you, Harshal. So I think there are two or three key themes that we're looking into this year, and to some extent the seeds of those themes have been sown in 2024. I think one of the biggest questions that our investors are asking us is that where is the growth headed, and especially growth headed from the private economic agents end. So private sector, which is private consumption and private investment, would consist roughly around 70% of the economy, to be very honest, and they have been largely absent in the last 6 months, specifically in a combined basis. And the bigger question that people are asking is that, are you going to see them turn around in 2025? Because that will really shape the growth dynamics in India, and probably would also impact the investing regime for us. From our point of view, I think we believe that FY25 is going to be much lower growth story than what most market guys have envisaged, and probably even the government of India has predicted for the year at 6.4%. We are still looking at a 6% growth story in India, and FY26 would be more like a U-shaped recovery, rather than recovery, more a range-bound growth story. I think we are stuck in that 6.3 kind of range for the next year also, and the private economic agents to a large extent for us would be still a missing link. Now, if I look at the rural and the urban consumption bit, so last 4-5 years, whenever there's been any kind of improvement in sowing activity, people start getting very excited about the rural economy in general and start taking very big bets on the rural sector-led investment thesis. While I think we have been a little more cautious on that front, because one had to understand that the rural economy is only 20-25% agriculture, rest is non-agriculture, which is led by services largely, just like the rest of the economy is, and then to some extent manufacturing and construction. And that segment had gotten decimated from back-to-back shocks that the economy faced since demonetization. The unorganized sector across the country had obviously suffered since 2016, but obviously rural doesn't have that strong a balance sheet, so they were actually much more hit. And those three shocks of demonetization, GST and COVID had actually decimated that particular segment of the economy. So when we saw massive job losses in the rural sector post-COVID, we lost around 8-9 million jobs, and they still haven't fully gotten recouped. But whatever initial leg of improvement in the labor market that turned out of the job losses that we saw, all of it had actually gone into agriculture. And services actually saw more than 15 million job losses on net in 2 years into COVID, because they really couldn't recoup with the pain that they were facing. And that essentially led to a much worse labor dynamics in the rural sector, where there was low productive and low income generating employment scenario, and that had essentially meant the real wages remained negative. After a long time, I think we are seeing rural wages getting into the positive territory, which is a plus sign for us. But more importantly, the composition of labor incrementally has improved towards services in the last 2 years, which again will imply that the rural purchasing power capacity has improved, which is again reflecting the fact that the rural spending pattern has moved a bit away from food to non-food or discretionary goods. So I think a lot of factors that we're tracking in rural have turned a little positive for us in terms of how we're seeing rural terms of trade versus urban. So I think cyclically a recovery is on the anvil, but I think it's again an interaction between rural and urban consumption that also matters, and that is where the missing link will be on the urban side. So in the urban bit, post-COVID, you saw a very K-shaped recovery kind of a thesis which worked out everywhere in the world. There was urban with rural divide. Within urban, there was divide between the rich and the relatively non-rich category. But then came the upper middle class, which was really pushed well by the wage growth that you saw in the IT BFSI sector, where you saw almost 30% income growth and massive improvement in the labor dynamics as well, which impacted their purchasing power, and they also joined that premium segment of the economy. last 1.5 years, we've seen that actually peak in 2023 of March. Since then, the real wages of the urban segment have actually been coming down steadily, which is led by again these two sectors, and we are not seeing immediate respite in either their hiring abilities or their income paying abilities, which I think will weigh on the urban middle class strata for the longest period, because RBI is also not easing their consumption lending standards for the consumers. So I think the unsecured lending bit is a pinch for both rural and urban sector, which again had been tightened since 2023, and so it took a little bit of time for the urban to come off in terms of the consumption pattern. And I think even if we see an improvement in the urban employment, it will still be a slower improvement in the urban middle class. So I think that segment will be missing. Now the third private agent is private investment. So again, they are very endogenous to each other. If there is no private consumption, the private investment will be shy of investing. The second support they used to get from the government sector, where we are arguing that the government capex, both central and state, had plateaued to a sub 5% of GDP. The 2024 period saw around 5.44% of capex to GDP ratio was central plus state combined, which I think will be the new, will be the will be the highest that they've seen in the longest period, and 25 will probably see a sub 5% capex to GDP ratio for these two economic agents, and that will become the new normal for us. So the incremental push for the private sector in terms of crowding in will not come from that segment also. And thirdly, of course, you have excess capacity in the world. China is sitting with huge excess industrial capacity, which is somewhere finding its way into emerging markets and the developed markets. There will be little reason for them to really invest when they are sitting with huge capacity. So I think private economic agents are going to be a missing link in the growth story, and thus we think that we are in for a very range-bound growth in FY25, 26 as well.
Right. So with that context, if you're essentially saying that growth will be, if not challenging, there doesn't seem to be any immediate lever to sort of boost growth in FY26. We do have the budget now in the next few days. A lot of the talk in the media and wherever else has been around possibly the government possibly sort of bringing in tax cuts or tax relief in some form to help consumption. But at the same time, you have obviously the fiscal deficit target that seems to be quite paramount for this government, as well as the fact that capital expenditure, which has been, as you said, the public sector and especially the central government has borne the brunt of the capital expenditure in the country post-COVID. That seems to be reaching now a natural sort of ceiling. It looks difficult as to how much more the government can do. So with that, all of that, so if I were to put that into context, then what do you expect from the budget on Saturday? And do you think there's any room for the government, or in terms of being able to introduce anything that could sort of be even a short-term boost to growth for the next year or so?
I think for the government, both central and state, the bigger challenge is to improve the revenue generating capacity, because spending can only move further or can improve further when you have much higher income than what you're earning at this point in time. And that problem is, I think it's much more serious than the expenditure side. To some extent, both central and states, I'll focus more on central because the budget is largely centrally a story of central government. For the center, the committed expenditure is almost 55-60% of the revenue receipts that they earn. So they were left with only 40% or 50 or 45% of the revenue that they can actually spend in any discretionary or productive capacity creation. So there's anyway a problem with that, and that's why the policymakers have been very focused on bringing their debt to GDP ratio down, because interest payment has become almost 3% plus of GDP as a payout for them. So certain things they can't change on the expenditure side, certain things they have to spend. But if they intend to really increase their capacity to spend further without curtailing fiscal deficit from here on, the only way they can do is by increasing their revenues. So how do they do that? Either they increase taxes, which may not be the case, because taxes are a very beautiful automatic stabilizer in the economy. When the economy is looking to slow down, taxes is the first thing that will autocorrect. So you need not do anything with taxes. You are going to be more pro-cyclical if you increase taxes. You will probably worsen the cycle for the economy. But you can cut taxes. Whether that can happen, possible. This government is anyway talking about modifying the DTC, which probably will simplify the tax regime. We'll see how it pans out. Maybe they could increase the standard deduction in the new tax regime, or they can create more tax slabs in the new tax regime for say income beyond 30 lakhs to redistribute wealth in some way that it becomes more progressive and the wealthier class is paying much more and the lower middle class and the lower strata of the economy is paying much less. So they can fiddle with that. So that could be something to watch out for, but that will not generate revenue. It will most likely be them losing revenue in some sense. The other way for them is to focus on the non-tax revenue and non-tax capital receipts that they receive. Non-tax revenue is basically the RBI dividend. They have been pretty lucky for the last few years because RBI has been generating income for them. Last year they were given 2.1 lakh crore worth of profit from the RBI, which clearly helped them massively to manage their fiscal deficit, even though they could not do any kind of divestment whatsoever. And this year also we expect that they will be able to generate enough income because RBI has been extremely active in the FX market and have done massive FX sales so far, which while other things would probably impinge their profit, on net they could still be generating a decent 2 trillion plus kind of profit, which they will give to the government of India. But I think they can't depend on this source of income, right? I mean, RBI is not a trader for them. They can't be generating money. It's not like they will keep trading just to generate a certain amount of profit for the government to fund their fiscal deficit. They'll have to find more durable ways of generating revenues. And one of the only non-impinging way of fiscal deficit management is by being much more creative and innovative in terms of either a tax reform. Very difficult. I don't think they can ever capture the agriculture sector to be a part of the taxation regime. Maybe increase the compliance of taxes further. And the other way definitely would be for them to be going all out and doing some kind of asset monetization beyond just the divestment strategic asset sales. They can probably sell their functional infrastructure, which is already up and running. They can go ahead and probably sell something like an InvITs, which are very much in demand. So there are long only players which are very interested in these kind of products. So they have to go all out and do some kind of asset monetization in a big way, which will take care of your debt in one go. You will create revenue, and that revenue can be spent to increase spending, and your spending to GDP ratio for the economy will not come down dramatically. Thus, even though if you suppose you bring down your fiscal deficit to a 4.5 or a 4.3, 4.4, whatever the number they aim ahead, that can be achieved without them necessarily cutting on the expenditure, because that is what matters, right? Expenditure multiplier should not fall. If they're able to spend every year say around 14% of GDP, 15% of GDP of expenditure, by generating new avenues of income, they will be good with a lower fiscal deficit also. Then it's a difficult call to take, but then they have to get more innovative in terms of finding new ways of mobilization of revenue.
Right, so that obviously was about the budget. Now it is a very sort of jam-packed week as such, or the next 10 days or so, because a week after the budget then we have the RBI policy, which would be the first one for the new governor, Sanjay Malhotra. Now we've been hearing that the new governor is reportedly okay with letting the rupee find its own level, in contrast to what we'd seen especially in October to December last year, where the RBI intervened heavily to support the rupee. And that has obviously had implications for domestic liquidity as well. And obviously, speaking of domestic liquidity, we just had a bunch of massive liquidity announcements by the RBI yesterday. So with all that in context now, what do you expect from the RBI in say about 10 days time? And obviously a rate cut or not is the key sort of monitorable that the markets will be looking at, but what else could the RBI do to sort of improve both liquidity and overall sort of growth conditions?
So I think we have to split this question into two parts. One is, as you said, the pre-Malhotra regime and the current regime of Mr. Malhotra. Clearly, October to December period made us believe that RBI was literally obsessed with the rupee management. We were saving rupee to the extent that we spent almost 100 billion or more of reserves from our kitty in both spot and forward market, when there was not necessarily an attack on the currency per se, right? Between October to December, there was a massive dollar favoring trade which was running across the world because of two factors. One was that there was a narrative that Fed may not necessarily be able to cut further, which helped yields soar in the US, and of course the US growth exceptionalism compared to its peers in developed market, which favored the dollar. So it was basically a dollar trade and not a rupee anti-trade. But we went all out to save the rupee as if we were being attacked. Yes, there were some outflows that happened in India. FPI outflows were massive in October and November and till early December for that matter. A part of it is a natural thing that happens every year because every year and FPIs exit emerging markets. But yes, there was some bit of an outflow that did happen because the growth differential that we were enjoying versus emerging market was not looking to be as favorable. So there was a need to intervene, yes, possibly to the extent that was required. So fundamentally speaking, our estimates are that the BOP deficit for that particular quarter wouldn't have exceeded around $25 billion or a little more here and there. The numbers are not out yet. But our estimate suggests that RBI intervention was almost 4x or even more of that. So you don't do a 4x of forex intervention or 20% of your overall FCA or foreign currency reserves kitty in one go to save something which was not being hammered in the first place. And they're obviously paying a price for that at this point in time, because while they did not intervene as much in spot market, they ended up creating a very heavy forward book. And eventually when the forward book expires, you have to come back to spot to pay your forward position, which was basically sell dollar position of a 3-month or a 6-month forward contract that they had. In December, when the RBI met, the last meeting of the former Governor Das, made us believe that if at all this currency problem in the global market continues and RBI being obsessed with the rupee management, may get stuck in that policy trilemma wherein either they manage currency or manage policy making in the monetary policy space, or manage the FPI flows or foreign flows in a natural way. And they probably had chosen the former, which is the first case of rupee management, which meant that in case dollar remains a problem for emerging markets, RBI will not do anything. And plus Fed also may not necessarily cut much, which will reduce the wiggle room for them to do anything. And thus what RBI did eventually was to cut CRR, which led to 1 lakh crore worth of liquidity in December month. But still, as we enter December late, I think 3rd week of December onwards, there has been a consistent liquidity tightness that we have seen, which to the extent had reached to around 3.1 lakh crore yesterday, and which led to RBI doing what they did in terms of liquidity management, which was around 1.5 lakh crore worth of liquidity infusion measures. That also has happened at a time when the dollar strength thesis or theme has sort of lost a bit of its steam. The Trump rhetoric has not really worked very well after he joined office, and everybody around the emerging markets have gotten some breathing space. And also, as you said, that probably the new governor has made us believe that probably they realize they stretch too much and they're letting the rupee find its own value in some form, which gives them a lot of breathing space as well. Because once I decided I'm okay with the rupee depreciating, because I made it overvalued, I made it much. I mean, everybody in the EM market was falling, and I was the only one appreciating in that space. Made no sense to me eventually, and I should let the rupee actually autocorrect because it has a bigger correction to probably take care of. So when he sort of decides to let the rupee be, he gets a lot of free hand to do with policy making. And the first step of that again was liquidity management. They're indeed thinking of cutting rates, suppose in February, and assuming nothing bad happens in the global market in FX space between today and February meeting of the Reserve Bank, and they indeed end up cutting rates, the rate cutting would be a waste cutting, because if the liquidity is so tight in the system, there will be no percolation of liquidity, there will be no transmission of liquidity, transmission of rate cut in the system. So clearly they had to find a very conducive environment so that whenever, as and when they do rate cuts, they should be able to actually transmit into the economy. So I think they have signaled that we should ideally see rate cuts if nothing bad happen. Whether we'll see a very very strong or a very elongated rate cut cycle, I'm not sure. But whatever space that we have, be it 75 bips rate cut or even 100 bips rate cut, at least there should be enough liquidity in the system for them to be able to actually see the percolation of that happening in the economy, and that's very important. So I think it seems to be a precursor to a cut, but we'll see how it pans out. If nothing really bad happens in the global asset classes except for what is happening in equities, I think they should let the rupee, they should probably go ahead and cut rates, which also would be actually, for all be supportive of the rupee in the medium term, because unlike other emerging markets which are more exposed to debt and have open economy as far as the FPI debt holding is concerned, India is a relatively much more closed economy. We have only 3% of our debt which is exposed to FPIs. Thus, we don't necessarily have to create that so-called interest rate differential with emerging market, with the developed markets to attract foreign money, because India is a growth money story. So people come to India because it has a growth story or a growth differential with the rest of the world. If we're able to create that growth differential with other emerging markets, there will be a natural attraction of foreign capital, which will be largely equity driven, and that's where we have a bigger chunk, because at one point equities were, I think 25% of the equities were owned by FPI, which has fallen to 15% as of today. So I think that is where we need to fill the gap. So maybe a growth-led fiscal and monetary stimulus would be the next way for us. So I think rupee will find its own value eventually.
And lastly, just again sticking to the RBI, because obviously we've spoken about the rate cuts and the fact that they're setting the ground for the rate cuts through the liquidity measures that were announced. Anything you see in terms of sort of easing of regulations that were tightened significantly in the last year and a half or so on lending across various categories, because that is also now being attributed as a reason for, at least partly, for the growth slowdown. So if, as you said, if we are to bring growth back, if the RBI has to sort of foster growth again, one of the ways in which it can do that is by easing these restrictions somewhat. So do you see any space for that happening?
I think that would be one of the ways for them to ease much more than what they could do conventionally. We have been sort of arguing that if at all there is less space for conventional easing, this would be a great way for them to actually do unconventional easing. In December we talked about it. I think CRR cut was the first way for them to do that. Some easing in terms of liquidity norms to normalize the CRR to where it was pre-COVID. Followed by probably easing of regulatory norms, as you're mentioning. So last 1.5 years was largely not about rate hikes by the Reserve Bank, but more to do with the way they were making extremely tight regulatory norms for the banking system in general, which also led to a fall in credit creation in the economy, which eventually led to a fall in deposit creation in the economy. And any which way for us, for India, the credit penetration is very low. So if you do not have banks followed by NBFCs actually participating in deposit credit creation in the economy, there will be a sort of a slower credit growth compared to, say, even a GDP growth. And I think to that extent they had gone a little too far with their policy norms, and if at all they're not able to ease much more than what they would have liked. One way they can do is by either easing, say, loan deposit ratios for certain banks directly or indirectly, probably put much lesser provisioning on lending to NBFCs or infra financing projects that they had talked about, and even the LCR norms which they were supposed to bring in from April of this calendar year. Would probably get some tweaks which would be favorable for the banks in general. So I think somewhere they could relax some regulatory norms to create a much easier financial conditions for the economy and lending conditions at a time when there actually is a demand deficit in the economy. So they can probably create more easier way to lend so that people actually come and borrow. So I think that would be the next easing lever for the RBI, apart from just a rate cut that may or may not help beyond a point if they're not doing a very deep rate cut cycle.
Yeah, exactly. So that's it from our end for this edition of MK Macro and Market Movers. Thank you so much once again, Madhavi, for being here with us, and stay tuned. Like, share, subscribe to the channel for more updates, and we'll see you soon.